Hello, everyone. Today, we're going to discuss how to calculate the risk-reward ratio in Forex trading. This important ratio is a key metric that helps traders assess the potential rewards and the associated risks of an investment. By balancing risk and reward, traders can make more informed decisions and achieve long-term success in the Forex market. First, let's define what risk-reward ratio means. Simply put, it's the ratio of potential rewards to the potential risks. A high risk-reward ratio means that there's a greater chance of making a profit with a lower risk, while a low ratio indicates the opposite. To calculate the risk-reward ratio, follow the steps. 1. Identify your target profit and stop-loss levels. Your target profit is the amount you want to achieve from your trade, while your stop-loss is the level you're willing to lose. 2. Determine the size of your position. This is generally calculated as the total amount you're risking divided by the leverage you are using. Leverage can increase your potential profits, but it also increases your potential losses. 3. Calculate the potential profits and losses. Based on your target profit and stop-loss levels, determine the potential changes in price for your position. Remember to consider both positive and negative outcomes. 4. Divide the potential profits by the potential losses to get your risk-reward ratio. This number will provide an indication of how well your position is balanced in terms of risk and reward. In summary, understanding and calculating your risk-reward ratio is crucial for achieving long-term success in Forex trading. By balancing risk and reward, you can make more informed decisions and manage your risk effectively. Remember, the key to successful trading is to find a ratio that works for you and stick to it. Happy trading!